Presentation 2 in the Management of Finance section is about cash budgeting. So the learning intentions are to be aware of the different financial records that an organisation must keep. This is just going to be the first one. To understand the reasons for cash flow problems and how they can be solved. To understand the purpose of producing a cash budget and to be aware of the role of the manager in dealing with cash budgets. So this is just an introduction to financial records. We're going to be covering each of these financial records in turn, but this presentation is all about the first one, cash budgets. So the most common financial records that an organisation would draw up are cash budgets, income statements and statements of financial position. And as I've said, the next lot of work will cover income statements and statements of financial position. So a little bit about cash flow first. Cash is the most liquid of all a business assets. So when a business holds cash, then that can be turned into cash easiest because it is cash. Cash flow concerns the movement of money in and out of a business. Cash inflows, which is money coming into the business, should be greater than the money flowing out or the money spent by the business, and we call them cash outflows. Liquidity is the ability to have access to sufficient cash or ready cash, it could be in a bank account for example, to meet everyday financial commitments. So if a business is liquid, it means that it's got enough ready cash or cash that's almost there, for example in the form of a current account in a bank, to meet your financial commitments every day. Many businesses go into liquidation and close down because of the lack of sufficient cash to meet commitments, not because of a lack of profits. So what we're saying here is a business's profit can be high because you've sold a large amount, but these sales could be on credit. And selling on credit means you sell now and the person, the customer, will pay you later. But that means you've not got the cash available because they've still to pay you. So a business could be showing a high profit because of the sales, but they've actually not got the cash to show for it. And that's the problem for businesses. They could be showing high profits, but they haven't actually got the cash, which means that their liquidity is bad or poor. So cash flow forecasts, or cash budgets as we call them then. A business will use a cash budget to make projections into the future. So what we've got to understand here is a cash budget is exactly that, and it's a budget. It hasn't happened yet. You're projecting a few months ahead to see how much cash you are likely to have coming in and how much cash you are likely to have going out, so that you can see if you're liquid or not. They will use this to manage their cash and as a basis for decision making. For example, have you got enough cash to purchase perhaps a machine you're looking for, or does it mean that you're looking into the future to say, well, it looks as though I'm not going to have enough money then, so I better start thinking about alternative finance in the form of an overdraft or a bank loan. So what's the purpose of a cash budget? It's to monitor and control. You're comparing your budgeted with your actual results. So a cash budget allows a business to budget, to look ahead and see where they think the expenses and the incomings are coming from, and then they can actually compare them with actual results so that they can take action if these results are quite far removed from each other. They can measure performance of the organisation as a whole or individual departments or sections. So each department could have a budget that they have to control, and once again it allows the organisation to measure the performance of each of these departments because they can see whether they're sticking to within what they had budgeted for or not. It also allows an organisation to set targets. So for example, if certain aspects of the expenses are too high or incomings are too low, then what they can do is they can provide targets to make sure that they can get expenses down or get sales, etc. up so that more cash is coming in. They can highlight anticipated periods. Now remember, it's in the future, so it's not a definite, but you can see perhaps where you're maybe going to have poor cash flow, in other words, a cash flow deficit. You're spending more than you're actually getting in, and this can give you time to actually take corrective action, find some way of getting expenses down before they happen, or putting some form of loan, etc. in place. It highlights anticipated periods of surplus where you've got more money coming in than going out, or you hope to have more money coming in than going out, and that will allow the organisation to invest for the future. You can actually invest in equipment, etc. It's also used as part of a business plan, which could be drawn up by a new business prior to starting up, or by an existing business prior to expansion. Having a cash budget could allow an organisation to borrow money from the bank. So now we're going to look at reasons for poor cash flow, reasons why an organisation may have more money going out than coming in. You might be tying up too much cash in inventory, in stock, in the goods that you're going to resell. So you've maybe got too much of that and it's sitting in a store cupboard not doing anything. That's you wasting money. Offering too much credit to customers and allowing them too long to pay. What we were talking about there, selling goods but not getting the money for them for a long time. Taking on large loans with high rates of interest. Yes, you've got the money there in the form of a loan, but you're having to pay interest back, which is an expense to the business. Low sales, meaning you've got less revenue coming in, so you're not actually selling enough. Owners taking too much money out of the business. This can happen in smaller businesses like sole traders and partnerships, where the owners can actually take money that they have invested in the business in the form of equity. They can take that out in the form of drawings, and what that does is it means the organisation's got less cash available. It might be you're purchasing too many of your non-current assets. By those we mean equipment, machinery, vehicles, etc. And maybe you should be leasing them instead. You're maybe outlaying a lot of money in one go to buy a machine when you could be splitting it up and leasing it into monthly payments. And we know what leasing is, of course. That's where you're more or less renting or hiring an asset and you're never owning it. You could also have just generally high business expenses. So how can we solve these cash flow problems then? What you can do to encourage sales is maybe to invest in an advertising campaign and offer discounts. Now, yes, these are going to cost the business money, but in the long run, you could encourage more sales to help combat that. You could sell assets that you're no longer requiring. For example, it could be you've got machinery there, but you've purchased a new one, or you're leasing a new one. Then what you could do is sell those assets if they're still usable and get some money for them. You can try to inject more capital into the business. That could be in the form of more shares from shareholders. It could be getting more partners in a partnership, etc., to get more capital or equity into the business. You can find cheaper suppliers to reduce your purchase outlay. So what that means is you can try and shop around and find suppliers, reasons for choosing a supplier. We go back to that. Finding cheaper suppliers. If you're actually outlaying less money on your stock, your inventory, then it's obviously saving you money and there's less money going out. Reducing drawings or dividends to shareholders. So in the case of a sole trader or a partnership, try to discourage the partners or the sole trader should think carefully because it's their own business about taking money out of the business. Dividends to shareholders, try to cut the dividends to shareholders, but you still want the shareholders to receive something, so they'll hang on to the shares of the business. Ask trade payables for longer to pay. Trade payables are people that you owe money to. So whoever you purchase your inventory from, purchase anything from, we call them trade payables. And that means you want to try and extend the amount of time that you are taking to give them their money back. Because what that does is you can then have the stock or the inventory and then you can resell that before you actually have to pay them. So that could be a reason for you to do that. And try to have tighter control of your business expenses. Try to make sure that your staff are switching off machinery when not used, not maybe using photocopiers, etc. any more than they need to, all these sorts of things. Now this is a task that you would have been asked to do in class. I'm going to actually have you doing this as one of your tasks just now and using the role of the manager, the POCADM, discussed in the first unit. I would like you to discuss why cash budgets are important to managers.